This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Chris Verrone with us around the table, partner, head of technical and macro strategy at Strategas, a bed company. Chris, good morning to you.
Great to be here.
Is it time to buy that story in China?
I would say this. I wouldn't be sure. Think about how terrible the news flow has been the last 3 or 4 weeks. Probably the most bearish news out of China I've seen since 2008. And what hasn't broken down? Iron ore, Tom, to your point, has not gone down. Copper has not broken down. The Chinese 2-year yield has stopped going down. So I think the price action doesn't reflect the bearishness from the news. As someone who tries to marry how does price action versus news interact every day, it will be difficult for me to be here short and comfortable with that when I've gotten every piece of information in the direction of the bears and price won't break lower. So I think at a minimum, cover your shorts and open your imagination to the idea that something might be changing there.
Chris, you and I are trend-based analysis. There's a stochastic catching a knife in the dark and getting on a trend, staying on a trend. The trend you're most interested in is oil. I link oil demand directly to a Pacific Rim recovery. Am I right to do that?
I think we can link it to a number of inputs, that certainly being one of them. Limited supply. I think the supply side of this is equally as important. But at the end of the day, we've had this just bearish onslaught of Russia news and of China news. And what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership. When I look sector by sector, there's not another group that has, say, 90% of issues above the 200-day that has relative leadership inflecting again. That's the energy sector.
What does Exxon do? Just as one example, what does XOM do? I mean, basically, it hasn't gone down. As oil went from 120 to 70, whatever, back up to 80 as well. Is oil catching up to the equity stocks, or do the oil stocks surge ahead of a recovering oil?
You know, Tom, I think one of the things we try to do in our work is understand the regime we're in, and therefore we know what rules to play by. I think for so many years, every single rally in crude was one you could sell. Every time the energy stocks bounced, you should sell them. This is a different regime. We've had 6 months of a benign consolidation in energy, and now it's reasserting itself. To the point on Exxon, what I'm encouraged by is a lot of the return to leadership from energy has come without the major integrators doing a whole heck of a lot here. This has been the service names. This has been the E&P names. Look at some of the big global names here as well, which have all really reignited in terms of a leadership story.
Okay, what about elsewhere in cyclicals, financial stocks in particular? I know you're looking at some of the banks. We were just talking about how we're continuing to see the ramifications of the failures we have seen this year. What's happening in those guys?
I think if you told me that the bank index would be down 15% year to date, I wouldn't guess the S&P would be up 15% year to date. We went back yesterday and looked at every major S&P low over the last 100 years. This would be the first time in 100 years where you're nearly a year off the low last October, where S&P is up some number and banks are actually down. It would be more normal if banks were up 70% here. They're down 15 from where they were last October. When you go name by name, it's just odd to me that Citigroup is back on the lows, Bank of America's right there, Goldman and Morgan Stanley look weak, and we know the regionals have rolled. I think it's difficult to entirely dismiss that. I think the benign explanation is, listen, 50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
So if you're saying we're too pessimistic on China, are we too constructive on the United States?
Yeah, I think we're probably too constructive on Europe, which I think is deteriorating right now. Like, look at 3-month low German DAX, 3-month low French CAC. And, what drove a lot of those markets were European luxury names. Those have all rolled here. European discretionary has rolled. So in a way, go back 14, 15 months ago, Europe was kind of first to bottom, turn up and lead. That seems to be flagging here. So I think before you talk about U.S. at major risk, I think there's a change going on in Europe. You see it in Euro-USD cross as well, which has come in sharply as U.S.-German rate differentials have changed.
So what am I positioning for? Dollar strength? What are you looking for? Where are you positioned to take advantage of that?
What's funny is I think it's interesting how consensus short dollar is, yet dollar's really not going down almost against anything I pair it against. In a way, Tom, it actually makes energy's resilience here even more noted, that it's happened even as dollar has firmed. But dollar's firm against yen, it's firm against euro, it's firm against sterling, it's firm against CNH. So hard for me to really embrace the short dollar call when it's just not on the charts.
Yeah, I'm looking at BBDXY, which is a blended bank index, which includes a lot of emerging market in China as well. And to be kind, it's well-behaved and centered trend on the trading envelope, 2 standard deviations as well. You suggest that breaks stronger?
I think if you look pair by pair, it's hard to come up with a really compelling short dollar call here. Even like Aussie USD, right? That's been soft. I think the pair you ought to focus on here is actually Euro CNH. Euro has been so strong versus CNH for the better part of the last year. That actually seems to be changing here. And I think it's in step with this idea that something's changing with China. Perhaps a stronger CNH relative to Euro is one more sign in that direction.
You got a call for Lagarde next month, September 14th.
When I look at, say, German rates as kind of our barometer here, they've effectively been in this range for the last 6 or 7 months. My experience in this business is always surprises break in the direction of the trend. And I think the trend in global rates is still up. So I think if there's a surprise, it's rates have one more last push in them. That would be our guess.
Chris, this was awesome. Thank you, buddy.
Thank you.
Thank you. Chris Verrone, the Strategas there. If you want a call on the FX market, Goldman Sachs out with the call on the FX market. 6-month call, dollar yen. They were looking for 135, TK. They're now looking for 155 on dollar yen. They're going back to the 1990s on the Japanese yen. Governor
Ueda had the chance to clear the air at Jackson Hole. From what I can tell, he did not. There's a huge uncertainty there. And here, what you said, John, 135, and the Goldman Sachs calls what?
They're looking for 155. The call wants 135.
147 right now, and I would say Kitchukes and others are really heightened here at 147, 148. I don't know where you break through 150, but I'm sorry, the Bank of Japan, the Ministry of Finance will defend the yen on the path to 155.
You've got a level in mind there, Chris, for when that happens for the BOJ. Higher. How much higher?
Weaker yen.
I'm drawn to the 55 number. It's an important Fibonacci number, actually, if you look at kind of the long-term dollar-yen chart. But you kind of can't have it both ways. You're either going to defend the bond market or you're going to defend the yen, and I don't think you can do both. The big winner, though, I think, is domestic Japanese assets. If they're doing everything they can to keep money at home, I think Japanese bank stocks reflect that. They're the strongest bank stocks anywhere in the world. I don't think that's an accident.
Chris Verrone, got to thank him twice.
What a joy to get a brief summary from Jay Bryson, Chief Economist at Wells Fargo. I love, Jay, the 2 sentences in your report on a real yield, an inflation-adjusted 10-year yield that will, quote, drift through 2%. What's the ramification to our viewers and listeners of a 2.1 or a 2.2% real rate?
Well, so I think the ramification is that exerts significant headwinds on the U.S. economy. I mean, what you look at with the real rate, and Mike was kind of talking about this before, is that's what matters for the real U.S. economy. And if the potential growth rate of the U.S. economy, no one really knows exactly where that is, but let's call it roughly 2%. I mean, you kind of want a real Fed funds rate, at that or maybe even a little bit below. That would be neutral. You get north of 2%, then you're putting some real restraint on the economy. Whether it's enough to actually cause, a technical downturn, technical recession, right, that kind of remains to be seen. But even if it's not enough, it certainly puts headwinds on the economy. It slows growth in the U.S. economy.
I mean, Jay, I've got a Bloomberg Financial Conditions Index. A positive 0.31. Folks, all you need to know in the mathiness of it is it screams accommodation to me. How many rate rises do we need to get truly restrictive?
Well, so Tom, the index that you're referring to, and just for your viewers, it comes up with there's 10 different variables beneath it, okay? And one would be credit spreads on corporate bonds, one would be volatility in markets, things of that nature. Those are the big sort of things. And so how do you get it more restrictive? I guess it would be if the Fed were to become really more hawkish here. And so you start to price in some more rate hikes in there. That leads to volatility in the stock market. That pushes bond spreads wider. All those things really matter for the real economy as well. And right now, markets have been, I would say, very accommodative recently. Bond spreads have narrowed. The stock market's holding in there. But if we get, let's say we got a bad PCE print, tomorrow, or a really strong labor market number, and people start to believe, okay, there's even more tightening coming in there. You'll start to see that tightening in terms of the financial markets.
But the question is, when that tightening will come. Even if we do get those things this week, if we get a blowout jobs report, if there's more inflation pressure than perhaps the Fed would like to see, would that actually result in a hike in September? We were discussing earlier how the bar for next month seems quite high. Would they still not pause, wait to see the lagged effects perhaps kicking in more, then make a call on November?
Yeah, Kelly, we agree with your sentiment there. I mean, I think as you said, the bar for a rate hike in September, I think, is pretty high at this point. I think, my sense is where the consensus on the FOMC is right now is we want to see a little bit more data. And so if you do get a blowout jobs report, if you do get a bad PCE print, I think what happens in terms of markets is that pushes the probability of a rate hike in November up. But that would also, I think, lead to some volatility in markets.
Jay, a question with immense respect for what Wells Fargo's done on labor economics for decades. Is our job market countable, or are we going to be surprised every jobs day forever, where we really, guys like you sort of don't, and your great team, don't really have a handle on the countability of the two surveys?
Well, so, when we look at our model, we look at the error bands around that. Our estimate, the error bands around our estimates are, somewhere like plus or minus 70,000. So, in some sense, you are throwing a little bit of a dart with that, and then that gets magnified in terms of the pandemic, because that just puts so much volatility into the underlying numbers that you're using to try to come up with a prediction. So, as the pandemic stuff starts to fade away over time, I think those error bands will start to narrow. But it's always, at the end of the day, a little bit of a guessing game as it relates to the labor market.
Yeah. And as it relates to, the headline figures on non-farm payrolls. But when we think about some of the other components of the labor market data, specifically the upward pressure perhaps on wages. We were speaking with Citi earlier on in the show about what we're seeing in terms of strike activity and union activity and the power of labor in pushing for higher compensation. How should we be thinking about that and how it relates to the Fed's fight against inflation?
So you get a lot of headlines in terms of, unions and things of that nature. I want to say that, I don't remember the number off the top of my head, but I want to say the percent of the labor force that's unionized today is only like 6%. I mean, we're not talking the 1950s or 1960s here. It's a much smaller sort of piece of that. And so it gets a lot of headlines, but at the end of the day, it's a marginal sort of effect in terms of wages.
And sorry to interrupt, but the thesis, the thinking from Citi says that this is more just an indication of the supply problems we are still seeing in labor, which is why workers feel empowered to ask for more. And in theory, that goes beyond unions.
Yeah, that's a good point. I mean, obviously the labor market is very, very tight right now. To push for higher wage gains, it's easier when you are unionized, when you have collective bargaining, than if you're just out there independently doing it. But the point is that the labor market is tight. But anything that we've seen right now, whether you're looking at the ECI, whether you're looking at the employment cost index, whether you're looking at average hourly earnings, all of those things show there has been some deceleration in terms of wages. Now, we're probably still above where we need to be consistent with a 2% inflation rate. But that said, we're not getting the same sort of upward pressure on wages that we were, say, last year at this time.
Jay, personal income, personal spending, are they acting in a normal way?
Personal, yes. I mean, given as tight as the labor market is right now, personal income is acting in the normal way. If you look at the last, I don't know, 10 out of 11 months, we've had positive real disposable income growth because wages are growing faster than what prices are going up right now.
Jay Bryson, thank you so much. Dr. Bryson is with Wells Fargo. Joining us now, smartest guy in the block, Jon Lovallo, U.S. Homebuilders analyst at UBS. Did you see this coming? Were you pounding the table UBS strong buy back when everybody said they're all going to die and they didn't?
I'll tell you, we came out of the gates pretty bullish when we launched about a year and a half ago, and we did not expect this to play out the way it did. However,
your thumb up. You were a thumb up at the time.
100%. And I mean, we were looking at stocks that were trading at a fraction of book value when we saw very little risk to book value.
Now what? I mean, at D.H. Horton, venerable company, are they all the executives all unloading shares and that on a log basis? It's log convex to say the least. I'm going to call it a moonshot. Now what for the home builders?
We're still bullish. I think that it's an incredibly interesting dynamic that's playing out right now where there is just very, very little existing home inventory, 3.2 months to be exact. That's about half of what it should be. And so you couple that with the fact that demand out there is still resilient, regardless of the fact that rates are at 7.5%. And the demand is all being funneled towards these public home builders.
I just wonder how long that could last, Jon. If we're north of 7 already, on the approach to 8%, that's got to hit demand at some point, even for people who are trying to buy new.
100%. But the beauty of being a public home builder is that you have arrows in your quiver. What they can do that the existing
incentives.
So they can buy down mortgage rates. And not only that, they can build smaller footprints. They can build a little further away from the city center. So there's optionality that the existing home market doesn't have. You can't pick up the home and move it. And so there's a lot of things that are favoring being a builder at this point.
So, Jon, in the UK, this can slowly correct because the fixed rate mortgage over there is maybe an agreement for 2, 3, 4, 5 years, some even on floating rate. The US mortgage market, 30-year fixed. I'm trying to work out, Jon, are we facing something generational here? Is this something that goes over the next decade, 20 years? How are you thinking about that? Just what kind of time horizon have you got for this to play out?
I think that there's a long, long runway here in the U.S. housing market. You have, first of all, massive generational wealth transfer, $68 trillion being funneled from baby boomers to millennials and Gen X. And you have an underbuilt housing market in the U.S., and a lot of millennials that are coming to the market right now that have been kind of shut out of the market for 15 years. And all of a sudden they're saying, well, you know what? I think we do want to own a home. They're a little bit wealthier than prior generations. They have the ability to borrow from parents and so forth. And so that capacity and ability to buy is actually there. And you add to the fact that
our housing market is based on rich parents giving money to kids.
That's part of it, for sure. But I would say that the generation that's coming through right now as a first-time home buyer is a little bit better heeled than prior generations because they're a little bit older. They're doing things a little bit later in life. And so there is wealth that has been accumulated. And this is a need-based buyer, right?
Okay, the fancy people you follow granite's out now, right? In kitchens, you don't do granite
It's
anymore.
Quartz now.
Quartz, thank you. Kaylee Line's on top of that. Everybody you talk to's got quartz kitchens. Why can't we build a starter home that's respectful? Why can't we do that?
It's a great question, Tom. I mean, the one thing that this industry has not done over the years is really sort of adopted technology like other industries have. Think about the automotive industry, right? They're building a home today exactly the same way it was built 100 years ago. So there needs to be technology infusion into this industry. There are a lot of players that are working on this.
I mean, Jon, we had an ice rink in the backyard, and the ice skates to the refrigerator cut through the linoleum floor, and nobody cared. And now, it's a quartz counter, right?
There's
What's
an
a quartz
aesthetic to
counter
maintain.
cost? Yeah.
Well, but on the subject of costs and of the tools that are actually being used to build this home or these homes, part of the issue with rates being so high is because there's a fight to get inflation down. And a lot of that inflation was actually just driven by supply chain challenges. Are builders still contending with that? Are there any supply issues that still are being worked out?
The supply chain has gotten much, much better. I mean, there are still some hangups on electrifying communities, so transformers, things of that nature. But in general, the supply chain is getting a lot better than it was. And I would say, the biggest sort of headwind, if you will, would be labor. And we're just, in a labor-constrained market. But the public builders, given their size and scale, have the ability to attract and retain better than the smaller builders.
Okay, so as we're talking about the different public builders and of the different, to Tom's point, a starter home versus elsewhere in the new build landscape, between like a luxury player, a more luxury-oriented player, or one that is more for that base consumer, who fares better in this environment? Is it the luxury end?
It's a really good question. We still actually favor the entry-level first-time buyer, and that would be a D.R. Horton, and that's because this is a very need-based, life-driven buyer, so marriage, children, things of that nature, that require more space. And so to the extent that that person can make the math work, they're going to make it work. And you know what? The public home builders are going to help them make that math work. Now, to your question, though, we like the other side, too. So sort of a barbell approach, where a Toll Brothers of the world, for instance, who just reported a massive quarter, that buyer is a little bit more shielded from interest rates. We have 25 to 30% that are buying with cash, for instance.
How disciplined are these home builders being? That's what we're really trying to get at here.
Yes.
When you are able to construct really bullish theses for things like home builders, where we can sit here and say this might be a 10, 20-year runway for these guys. If I'm listening to that, I'm just like, let's build, let's go, let's go, let's go. How disciplined are they being right now?
It's a great question, and it's really what has changed between today and maybe pre-financial crisis, that there's been a lot of discipline instilled in the market because of the pain from the past. But maybe just as importantly, there are some capacity constraints, particularly on the labor front, that will not allow them to overbuild. So even to the extent that the industry wanted to overbuild, they wouldn't be able to. So there's natural governors to the growth, which I think are very healthy.
I can't wait for these high prices for the rest of our lives, Tom. Seemingly that's the story right now. That could change. When you say things like that in the housing market, you just wonder how quickly things can change. John, thank you. John Lovallo there of UBS.
This is a joy because he is the one who has been right. And also he's the one who's been responsible. Andrew Slimmon joins us right now with Morgan Stanley, Managing Director of FEAR, Senior Portfolio Manager at Wrigley Field in Chicago. Andrew, flying over Wrigley Field, I'm sorry, going into O'Hare there and looking down at Wrigley Field, it's God's country. You are in the market. How do you find the courage to be in the market now?
Well, I think really the story of this year is, it's a tragic story in many ways, which is stocks look forward, but as Warren Buffett said, people use the rearview mirror to frame their viewpoint. And we had a terrible market last year. And that's when you're supposed to get more bullish after a down year. Right. People looked in the rearview mirror and saw a down year and got more pessimistic. So it was in hindsight, it was pretty, in my opinion, you had to put the chips in because we had a bad year last year. And what I see now is all that money that washed out of the market hasn't capitulated back in. Sentiment has gone up, but flows haven't turned positive. And I've never seen a bull market where ultimately people reverse and flow back into the market. It happened in 2021. I think money market yields being where they are keeping people on the sidelines. But I just refuse to believe that ultimately this cycle won't end the same way, which is we got to get everyone in before the boat sinks.
How do you identify a second leg of the bull market? You and I know the pop off 74, first leg up off that mess was amazing. And then shock of shocks, I believe it was January of 75, we had a moonshot out 18 months. How do you figure out you're beginning a second leg?
Well, I think there's, in terms of from now to year end and then looking further out, I think we're in a pause period now, but I suspect we'll have a strong fourth quarter for three simple reasons. Number one is what I said is, and Jonathan's actually quoted me on this, which is the pain of being out of the market is going to become more acute as we get in the fourth quarter, knowing that you got to go see clients and report, how they've done relative to the market. That's first. Number two is earnings growth rate is going to inflect from negative year over year to positive later this year. And thirdly, and I don't think this gets enough focus, the amount of money that the government is going to unleash in the CHIPS Act, Infrastructure Act, IRA Act, all coming starting the fourth quarter is huge. and that is going to invert the M2 positive. That's another reason. So all those, I think, will drive the market higher. What I struggle with, and you guys have already touched on this, is how are we going to get back to 2% target, which is what Jerome Powell told us last week he's still targeting, with wage pressures, all this public works spending coming. I just don't see that, and that worries me about next year.
Okay.
But I think for this year, it's a good setup.
Okay, well, but to expand on that point, and we actually were just getting headlines out from President Biden related to the Medicare drug negotiation, part of the Inflation Reduction Act, to what you were just referring, trying to lower healthcare costs. But to your point on all of this fiscal stimulus, an impulse that could kick in later on this year and going forward, does that good thing then become a bad thing when you're talking about more money being pumped into the economy and potentially what the Fed is going to have to do to counteract that force?
Sure. But absolutely, it's a long-term negative. But look what happened, COVID. We pumped a ton of money into the markets, into the economy, and the market responded positively. So I think there's a positive response to that spending money. And we hear it from the companies. And this is one of the reasons why I like the industrials. We're hearing these companies say the money is coming. We've got projects set up to do. So I think this will drive a big part of the economy and earnings. But it's going to extend this inflation fight longer than I think many expect.
Andrew, inside baseball question. Jeff Curry at Goldman Sachs, retiring there out of the oil racket, talked about how the new yield structure, getting us back to pre-2007, makes inventory management in hydrocarbons completely different. I would suggest across America, we underestimate what inventory management, given a real yield, how it changes corporate behavior. I would suggest corporations will begin to adjust viscerally to these new yields. Do you agree?
Well, there's no question a rising yield curve creates a higher cost of capital. And eventually that's why, rates going up causes a recession. And I don't question that inverted yield curve is also suggesting that. The question is when, and it's not very good at predicting. And I think what is really going on here is that actually for most of the companies in the S&P 500, higher yields is a net positive because they've locked in fixed rates, but they're making more on their cash. So right now, it's not a negative, but certainly as that debt comes due, the cost of capital will increase. The other thing that will slow is ultimately CapEx spending because projects are harder to justify at higher yields. I think that's all to come. I just don't think it is this year or early next year.
Andrew, is it a negative for the banks?
Yeah, again, it's the cost of capital. So I think that the spread, the margins remain higher. What I worry about, will we have another SVB crisis out there? It doesn't look that way. We watched the borrowing at the window. It doesn't look that way to us. But ultimately, are there other banks that have a duration issue? That's a tough question to answer.
They've just not traded well over the last month, TK. The financials, it's been a tough one. Even with
there are other areas in value I would search for.
Andrew, do you want to finish there? You've got about 15 seconds if you want it.
Well,
what are those other areas?
Sure. I think the industrials look very attractive because I think with this public work spending coming, I'm very comfortable that these companies are going to make or beat the numbers, whether it's materials, industrial companies, with this spending that's already been approved. So this has already been approved. I think that's a cleaner area than financials right now.
Andrew, thank you, sir. Andrew Slimmon there of Morgan Stanley.
This is a joy on your biggest headache, besides what we've said on housing and all today, and that is never and always airlines. Sheila Kahyaoglu joins us right now, Senior Equity Research Analyst at Jefferies. And once she dabbled in leverage finance, so she's got a really twisted financial understanding of this crazy business. Sheila, my arch question is, do you change what is the behavior of senior managers? Are the senior managers now at United, Delta, Southwest, all of them, are they not like 1 or 2 generations ago where they're actually going to deliver a more persistent free cash flow?
Thanks, Tom. You give me a lot of credit. At Jefferies, I focus on equity coverage, covering aerospace, defense, and airlines. So I get the benefit of covering, 3 segments of the market. And we're quite negative on the airlines, just having our other coverage with the OEMs, mainly because of pricing and what we're seeing the low-cost carriers doing. But we do think the network carriers are better positioned, like the Deltas and the Uniteds of the world, that are getting that premium customer base versus the network carriers, versus the low-cost carriers that might see a little bit more pricing softness potentially as people's pockets move.
Okay, so to that point, if we're starting to see a little bit of a deterioration in the pricing power of some of these airlines, is that to suggest that travel demand post-summer, now that it's winding down, isn't going to look as great?
I think that's the question. I don't think, first of all, I think corporate is stagnating at 85%, 90%, and some of the meetings are getting replaced by Zoom permanently. So we haven't seen corporate improve. And across the airlines, nobody's really calling for a massive improvement here. International has been recovering and is doing really well. And that's where we're seeing the pricing momentum. And that's why United and Delta are really benefiting, prices up 25% plus. On the U.S. domestic side, U.S. domestic flights are still up year over year, but down 10% below 2019 levels. And we're seeing pricing stagnate there. So is the wallet moving to international, or are we seeing some customer softness there? That's the question that remains to be seen for 2024. But despite that, a few weeks ago, we downgraded Southwest Airlines to an underperform rating, first underperform on the stock. Basically because we think that they have to change their network. They announced a $500 million network optimization plan that's going to go through the first half of next year.
Okay, so if we're talking about some of that pricing power going away, the pricing not being as strong on the input kind of side, then it's also the question of output and cost, especially in light of the deal, for example, American agreed to with its pilots, some of the cost pressures on the labor side. Also what we're seeing in terms of energy and fuel costs. What's going to happen to the profitability of these airlines if they have those two dynamics happening simultaneously?
I think that's the concern here. How much does the profitability shrink? If pricing is going down, fuel's going up, salaries are going up. American 2 weeks ago announced that, their pilot agreement, they didn't change their full year guidance because they took down some other expenses, and they were pretty ambiguous on what those other expenses were. So how does that now affect 2024 costs? And how does that shrink the margin profile of these airlines? And that's really why we're negative on the sector, as we think, pricing, although 15% above 2019 levels, probably stagnates here. Right. We'll see what international pricing does next year, but we don't think domestic improves.
Hey, Sheila, the airplanes are packed. That's my amateur observation. They're absolutely ridiculously packed. Every seat's taken, it seems. I remember when they were 74, 76% capacity. And yet I keep getting emails telling me that they're putting on flights internationally and particularly across the Pacific. Are those planes going to be full? Are those proven add-ons?
So I think that's where you're seeing the issue. Load factors is what we call them. They, like you said, Tom, they used to be normalized in the high 70s, and now the high 80s are the new normal. But Southwest saw 83%, I believe, in the second quarter, which was relatively low for the highest travel season. So it depends. It's on certain markets. One of the examples they cited is certain cities in the U.S., there are more work from home. So you don't need that necessary connecting flight to a major hub. So that's where you're seeing the softness. But I think international demand and capacity is still well below 2019 levels. International capacity, and that's driving the demand and the pricing there.
I don't know if you've seen this story, Sheila, but Alex Milson here for Bloomberg with the only story that matters today. There's going to be an adult and child section on airplanes. You got to be kidding me, Sheila. LaGuardia to DFW, there's going to be a children's section on the airline?
I must have missed it.
Okay, Sheila, here's your context. This is one European airline, Corendon Airlines, is going to pilot a no-kid area on a 10-hour flight just between Amsterdam and Curacao. You can pay $49 to sit in the exclusive adult-only zone.
What do you think, Sheila?
I didn't know that was a coveted route that needed a specialized, section, but good for them if they think that's a niche market.
Sheila, thank you. Sheila Kahyaoglu with us with Jefferies here. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.